Welcome back, everyone. Michael here with Offshore Citizen. We have talked in some previous videos about the FIRE movement, which is financial independence, retire early. And one of the strategies there, but not just there, in a bunch of areas, is to use dividend investing. Okay, so certainly it's not a requirement of these movements. However, a bunch of people are very interested in dividend investing, and there's whole groups that are dedicated to dividend investing. Now, typically, when you're talking about dividend investing, you're talking about it from a domestic standpoint. So you have somebody, say, in Canada who's doing dividend investing, or you have somebody in the US who's doing dividend investing, et cetera, right? When we're talking about the situation for digital nomads, or people who are going abroad to other countries, this picture may change. And so I'm going to talk to you a little bit today about my perspective on dividend investing, and in particular my perspective on dividend investing for people who are trying to be tax optimized digital nomads, international global entrepreneurs, international investors, etc. So let's dive in. Before we do, if you haven't already, please hit the subscribe button, hit the notification bell. If you like the videos, give it a thumbs up, share it with your friends. And if you would like help with the things we deal with here, which are kind of global strategy, figuring out where to relocate yourself or your business or both around the world, how to protect your assets, pay the lowest legal amount of tax possible, bank in other countries, have a plan B, getting residencies and citizenships, we can help you figure out the best strategy for you, as well as implement that strategy, forming companies, opening bank accounts, getting residencies, citizenships, etc. Please reach out to us. You can book a call, calendly.com/Michael-Rosmer. There's a link in the description below. Or you can send a message through offshorecitizen.net. Okay, so dividend investing, what is the appeal here? Well, the appeal, of course, is, at least in theory, that the dividends are, well, they are going to give you cash flow, so this potentially allows you to live, and maybe has some sort of risk mitigation if you're in a situation where the market is doing poorly, right? So, okay, fair enough. Let's address kind of both of those. Now, it's worth understanding, and this is part that I'm going to focus quite a bit on, that in a lot of countries, dividends are taxed favorably. Okay, so usually you'll have some sort of like qualified dividends or something like that if you're looking at a country like Canada or the US, UK, etc. A bunch of these places have favorable tax treatment for dividends, different from the regular taxes. And so, in certain cases, on the surface, this might seem pretty good. Now, I'm going to kind of explain why that's not actually as good as it sounds in a second. But let's just talk about the perspective if you're somebody who is global. So let's start by understanding that from a cash flow standpoint, yes, you get cash flow from dividends. To be fair, it's a really low percentage. In most cases, you're talking about, 1 to 4% per year as compared to the price of the overall stock. Sometimes you'll get ones that are higher. Usually, in my experience, dividends are kind of a red herring, and they can be really misleading. So back in the day, I used to pay quite a bit of attention and think, okay, maybe I should go with this stock. I should include dividends as a consideration whether I should buy. What I found is the reality is that if the stock can drop 10 or 20%, then you're better off buying based on what stock is going to perform well and forget about the dividends, and dividends were just a bonus. That was kind of my perspective at the time. I've since changed that perspective slightly in that I don't view dividends as a bonus. So if you look at the research that has been done on this subject, what you're going to find is that dividends do not boost overall performance. So in other words, the question is, okay, well, the stock price can go up more, or you can have a dividend. That's basically over a longer period of time. Yes, in a short period of time, like if you're in a down market, say you were, buying banking stocks from, December 2021 until today, this is August 2022, maybe the stocks went down a lot, and the fact that you were getting a dividend kind of reduced that damage. However, generally speaking, the dividend performance is included in the price of the stock anyway. And so you're not actually getting ahead in that regard. You might, like I said, it may help to temper volatility for you in the short term if you're very short-term focused. But if you're long-term focused, which is the better result for most people, right? Most people should be in a long-term focused environment with most of their investing, then really it kind of comes out in the wash. And because of that, what you should be more concerned about is kind of planning yourself as well as taxes. Okay, so this is where we come into the next part. If I am, let's say, buying a US stock, and let's say just for instance that I can choose to buy Apple, which does pay a dividend, or I can choose to buy, let's say, I don't know, Teladoc, which doesn't pay a dividend. Obviously, these are totally different companies, and this is not a reasonable comparison, but I'm just demonstrating the tax treatment on it, okay? Let's say that Apple goes up somewhat less and pays you a dividend, versus Teladoc goes up slightly more and doesn't pay you a dividend. Let's just say that those were two equivalents. If you're a digital nomad, or somebody who's a foreign person, not an American, okay, so not a US citizen, which of these is better for you? Probably, almost certainly, it is the Teladoc one. Why? Because of the fact that the US will levy withholding taxes on the dividends at a rate in most cases of 30%, which is insanely high. And under tax treaties, it can be reduced. The lowest is 5%, but most of the time you're talking about 10 or 15%. So you're still getting some withholding tax, which means, let's use a simple example. Let's say I decided to go to Portugal, right? So Portugal has no tax on dividends. Great, seems awesome, wonderful. But if I'm buying US stocks and I'm getting hit with that dividend tax, well, the withholding rate between Portugal and the US is 10%. So I'm really paying 10% tax, right? Similar idea if you go to a bunch of other places. I could go to, for example, Thailand. I could have no dividends if they're paid to a foreign bank account and brought into the country a year later and things like this. And okay, great. Thailand doesn't tax me, but the US levies withholding taxes, and that turns out to be pretty high. By contrast, now, of course, this assumes some tax planning that you're not going to get taxed on the capital gains on the receiving end, or the tax treatment on the receiving end is going to be equivalent. But capital gains will not be subject to withholding tax. So this is a very interesting function of the US tax system. Most of the time, the US disincentivizes you from taking money out of the US. But when it comes to buying growth companies, early stage, well, in general, the sale of shares are not taxable in the US. So you could literally buy the seed round of Uber or Google or something, and it could go 10,000x, and you could sell and you'd pay 0 US tax, even though that was a US company, which is super interesting. Whereas, if that same company distributed those earnings, that gain to you over the course of dividends, you're going to get hit with all this tax along the way. And so, I think when you consider should you be doing dividend investing, generally as an international person, not in all cases, there's no one size fits all, maybe you're in a country where it makes a lot of sense, but in most cases, it is not a very sensible strategy because of 3 things. One, long term, it's priced in, and so you actually don't get ahead. Number 2, you're in a situation where you're going to possibly have a worse tax treatment because of that. And number 3, if you want cash flow, you can get that anyway, simply by selling small portions of the stock. So in other words, you can kind of generate your own dividend, and if you're doing it by gradually selling shares, and you realize the gains that way, then great, you can go and you can do this as your kind of self-created cash flow. Now, what you might say is, okay, well, what about the concerns around price fluctuations and selling at the wrong time? Again, this is if you have a long-term perspective, and you also have another alternative, which is you can borrow against it. So you can do a margin loan, and margin loans in some cases can be like 0.75%. It's ridiculously low in something like Interactive Brokers. So very, very cheap margin loan cost. Okay, going up, etc., but extremely low cost, which by the way is a write-off in a bunch of these cases, and then kind of allow yourself to go through the ups and downs accordingly. So I would just say, in most cases, it's dividend investing is not an optimal international kind of global person strategy. What are some exceptions to this? As I said, if your timeframes are short, that may change things. Number 2, if you're investing in stocks in a country where the withholding rate is not actually going to affect you in this regard. Number 3, if the kind of back and forth tax treatment because of your country, so very frequently if you're a US person, let's use a quick example, if you're a US person in Portugal and you're investing, well then the US will tax you at a lower rate based on the dividends, right? And Portugal will not tax you under the NHR, so that's good. And at the same time, if you were to have capital gains, they would be taxed in the US and they'd be taxed in Portugal, and Portugal would end up taxing you at a higher rate than the US rate, so you would be net negative. So in a case like Portugal, for an American, so an American living in Portugal, this would be the situation. If you were, say, British living in Portugal, that would maybe be different. And so there's kind of this tapestry of many different scenarios. But in most cases, I would say it's better to avoid the red herring of dividends and instead focus on using capital gains, acknowledging that there are a bunch of cases where if you are in one of those situations, dividends might be better. So anyway, I hope that helps. If you have any questions, put them in the comments below. Reach out to us, book a call, send us a message. Happy to help you. And I will see you on the next video.